Americans over the age of 65 own 29.6 million housing units. That is close to a third of every home in the country, held by 18% of the population, according to a census analysis by the National Association of Home Builders. When one of those homes changes hands, the annual tax bill on it can double or triple on a house that has not moved an inch. That is not a critic's estimate. It is the warning a Florida County property appraiser prints on its own public page. The number driving it is not the sale price. It is the assessed value, the figure a county uses to calculate what an owner owes every year simply for continuing to hold the property. On a house bought in 1985 and never sold, that figure can sit hundreds of thousands of dollars below what the house is actually worth, and it stays down there as long as the original owner is alive. What happens to it the moment they are not is the whole question, and almost nobody asks it before the paperwork is signed. The house is the inheritance. The assessed value is the reset button. You inherit the bill. In California, that moment has a date, February 16, 2021. Before that morning, a parent could hand a child the family home and the low tax figure attached to it, and the county would leave both alone. The rule came from Proposition 58, approved by voters in 1986, extended to grandchildren by Proposition 193 a decade later. There was no ceiling on it. A house could be worth $4 million and still transfer at an assessed value set in the Reagan administration. The child could live in it, rent it out, leave it empty, sell it years later. The tax figure stayed where the parent left it. On top of that, parents could pass down another $1 million of assessed value in other property entirely, and two parents could combine that allowance. For 35 years, this was simply how California families moved real estate between generations. Proposition 19 ended it. Under the rule that took effect that February morning, the exclusion survives only if the property was the parent's primary residence, only if the child moves in and makes it their own primary residence within 1 year, and only up to a capped amount above the parent's assessed value. That cap currently sits just above $1 million and is adjusted every 2 years against the state consumer price index. Rental properties get nothing. Vacation homes get nothing. Second homes get nothing. If 4 siblings inherit and 1 moves in, the exclusion applies to that sibling's share, and the other 3 shares are reassessed at market value. Which raises a question worth sitting with, because the people who voted for this were, overwhelmingly, homeowners with children of their own. Why would a state full of property owners vote to strip the tax protection they had spent decades planning to hand down? The answer is that they were not asked that question. Proposition 19 was presented on the ballot as relief for seniors, for people with disabilities, and for victims of wildfire. And it did deliver that. Under the new rule, a homeowner over 55 can carry their existing tax base to a replacement home anywhere in California, county restrictions removed, up to 3 separate times in a lifetime. That is a real benefit, and for an older homeowner who wants to downsize without a tax penalty, it is a significant one. The restriction on inherited property is what paid for it. One group got mobility, the next group got the invoice. And buried inside the mechanics is a detail that almost nobody reads until it is too late. The reassessment is not triggered by a sale. It is triggered by a change of ownership, and the state defines death as a change of ownership. The county does not wait for a listing, a buyer, or a closing. It waits for a recorded transfer, and a death certificate is a recorded transfer. Any change of ownership, including one caused by a death, has to be reported to the county assessor, whether or not the property qualifies for any exclusion at all. The file opens the moment the owner stops breathing. What that means in practice is that the timer starts before the family has met with a lawyer, before anyone has discussed what to do with the house, and often before the heirs have any idea a timer exists. Miss the filing window, or fail the residency test, and the reassessment stands. Now, California is one state. It holds roughly 14 million housing units out of the country's entire stock, and the 29.6 million homes in older American hands are spread across every state, most of which never passed anything resembling Proposition 19. So it would be reasonable to assume this is a local problem, a California quirk, the kind of thing that makes for an interesting law school seminar and nothing more. That assumption is where most coverage of this stops. It is also wrong, and the reason has nothing to do with legislation. The mechanism that puts a house out of reach of the person who inherits it was not written by any legislature in the last 5 years. It was written in 1978, in a different state of mind entirely, and it is now embedded in the property tax code of most of the country. It was never designed to be an inheritance rule. That is exactly why it works like one. 1978. Property values across California had been climbing faster than wages for most of the decade, and because a county reassesses at market value, the tax bills climbed with them. The people who felt it hardest were the ones with the least ability to absorb it. Someone who had bought a house in 1955, paid it off, retired, and was living on a fixed income could open an envelope and find that the annual cost of staying in a home they already owned outright had risen again, for reasons that had nothing to do with anything they had done. There was no purchase, no improvement, no new debt. The neighborhood had simply appreciated around them. Proposition 13 was the answer to that, and it is worth being precise about what it actually did, because the popular memory of it is wrong. It did not freeze anyone's taxes. It capped the rate at which a property's assessed value could rise to no more than 2% per year, for as long as the same owner held it. 2%. That is the entire mechanism. Everything else follows from it. Florida built its own version in 1992, effective in 1995, written directly into the state constitution and known as Save Our Homes, capping annual increases in assessed value at 3%, or the change in the Consumer Price Index, whichever is lower. Other states adopted their own variants. The design intent was the same everywhere. Keep the person who lives in the house from being priced out of it by the market's opinion of their neighborhood. As policy goals go, that is a defensible one, and it was not a fringe idea. It passed by referendum, repeatedly, in states with almost nothing else in common. Here is the part that gets misunderstood by nearly everyone who benefits from it. A cap on assessed value is not a cap on a tax bill. Those are two different things, and the distinction is not academic. A property tax bill is the assessed value multiplied by the millage rate, the rate set locally by counties, cities, and school boards. The cap governs the first number. Nothing governs the second. A county can raise the millage rate in a year when assessed values are frozen and the bill goes up anyway. So what exactly was capped? Not the cost of owning the house. What was capped is the county's view of what the house is worth, and only for as long as one specific person owns it. That distinction is the whole architecture, and it produces an effect that compounds quietly for decades. Market value moves at whatever pace the market decides. Assessed value moves at 2% or 3%, or the Consumer Price Index, whichever is lower. In a flat market, the two track each other closely and nothing dramatic happens. In a market that appreciates at 7 or 8% a year for 25 years, they separate and they never reconverge. The distance between them widens every single year the owner stays put. In high appreciation Florida metros, that untaxed distance can exceed $100,000 of value after just 10 years. After 30 or 40 years in the same house, in a market that ran the way American housing markets have run, the gap is not a rounding error. It is often larger than the original purchase price of the property. Now hold two things in your head at once. To the homeowner, that gap is a benefit. It shows up as a smaller bill every year, and the longer they stay, the better it gets. It feels like a reward for stability, and in a sense, it is one. But a gap between what a house is assessed at and what a house is worth is not money in a savings account. Nothing was set aside. Nothing was paid down. What exists is a distance, and that distance is attached to the property, not to the person. It survives the person. And the entire structure holds together on one condition that nobody thinks of as a condition, because for 30 or 40 years it has been quietly, continuously true. The same owner keeps owning it. Every generation that built this system saw a shield. What they were actually building was a charge, deferred, sitting on the house, waiting for the one event that ends the condition. The question is how big that charge gets, and who is standing there when it comes due. Big enough that accountants describe it in whole multiples. A Miami tax firm working these cases puts the range plainly. On the same house, with the same walls and the same roof and the same street address, getting the cap right or getting it wrong is the difference between a $5,000 annual property tax bill and a $20,000 one. Not a percentage difference. A fourfold difference, arriving every year, indefinitely. In Los Angeles County, the arithmetic runs the same direction. Take a house bought in 1985 for $120,000, worth around $1.2 million today, held continuously by the same owner the entire time. The difference between keeping the parents' assessed value and having the property reassessed at market is roughly $13,000 per year. That is the tax line by itself. No mortgage, no renovation, no move. $13,000 a year for the privilege of the county updating one number in a database. Which prompts the obvious question, and it is the question that exposes what this system actually became. If staying put is what generates the gap, and the gap is what eventually detonates, why do these owners not simply sell earlier and take the equity while the market is high? Because the same rule that protects them from leaving also punishes them for it. Sell the house, buy another one down the street for the identical price, and the new property is assessed at current market value. The base resets. 40 years of accumulated protection evaporates in a single transaction. A retired couple in a 4-bedroom house they no longer need, who would happily move somewhere smaller, discover that downsizing raises their annual housing cost rather than lowering it. Florida understood this well enough to write a patch. Since 2008, homeowners there can carry up to $500,000 of accumulated Save Our Homes benefit to a new homestead anywhere in the state. California added its own version through Proposition 19, 3 transfers over a lifetime. Both patches are real. Both are also an admission. You do not build an escape hatch unless people are trapped. And this is where the design intent and the outcome finally part company. The stated purpose was to let an older homeowner stay in the home they had earned. It succeeded at that. It also produced a country in which the people holding a third of the housing stock have a direct financial penalty attached to ever letting go of it. The policy did not just permit staying, it priced leaving. Housing markets function through turnover, through units cycling between people at different stages of life. A rule that makes the largest holders of housing financially worse off for participating in that cycle does not simply protect anyone. It removes inventory from circulation and holds it there for decades. Meanwhile, the tax line is only the first of 3. There is insurance, which does not care how long the owner has lived there and which prices a structure built in the 60s or 70s according to its age, its wiring, its roof, and its exposure. And there is maintenance, which is the quietest of the 3 and often the largest. A house held for 40 years by someone on a fixed income is, more often than not, a house that has not been substantially updated in decades because there was no reason to. The owner was comfortable. Systems that still worked were left alone. That deferred work does not disappear when the deed changes hands. It arrives all at once as a bill to whoever now owns the roof. Tax, insurance, deferred maintenance. 3 charges, 1 house, all landing in the same 12-month window on a person who has just been through a funeral. Every version of this story you have ever heard assumes something about that person. It assumes they are young. It assumes this house arrives near the beginning of their financial life, when a shock is survivable and a spare bedroom is useful, and moving in is a real option. That assumption is doing an enormous amount of work. It is also, according to the Federal Reserve, wrong. Federal Reserve research puts the peak age of inheritance receipt at around 60, not 30. Not 35, 60, with most transfers landing somewhere between the mid-50s and the mid-60s. The cultural image of inheritance is a young adult receiving a check after a grandparent dies, and that image is essentially fiction. The mechanism behind it is not complicated. It is life expectancy. When parents routinely live into their late 80s, their children are in their late 50s and 60s when the estate settles. The transfer is not early. It is barely early enough to matter, and that single number rearranges everything said so far. Consider who this person actually is. They are not starting out. They own a home already, most likely, and they have been paying it down for 20 or 25 years. If they live in a capped state, they have accumulated a substantial gap of their own quietly on their own property, the same way their parents did. Fidelity's data puts the average 401k balance for Americans aged 60 to 64 at roughly $246,000. They are within a decade of retirement. Their income is likely at its lifetime peak and about to stop. A spare 4-bedroom house 2 states away is not an opportunity for this person. It is an operating expense. The timing is the cruel part. Money that arrives at 30 changes which house you buy and when you start a family. Money that arrives at 60 arrives after those decisions have already been made, without you, decades ago. Now, the rules do offer them a door. In California, the exclusion survives if the heir makes the inherited property their own primary residence within 1 year. Move in, file the form, keep the parents' assessed value. Problem solved. Except look at what that actually requires of a 60-year-old. Making the inherited house your primary residence means abandoning your current one. And your current one is carrying 25 years of your own accumulated cap. Leave it, and that protection is gone. Sell it, and the buyer's base resets while yours is surrendered. The escape hatch is real, but walking through it means destroying an equivalent shield you already hold. This is not a choice between paying the bill and not paying it. It is a choice about which of 2 caps to lose, which brings the whole structure into focus. A system built in 1978 to keep an elderly homeowner from being taxed out of a house they had earned does not hand its costs to a young family. It hands them to another near retiree, roughly 10 to 15 years behind the first one, who is standing in almost exactly the same position their parent was in and facing the same math from the other side. The protection and the penalty are not separated by a generation. They are separated by a single decade of aging. This was never a transfer from the old to the young. It is a transfer between 2 adjacent groups of people approaching retirement, and the one that arrives second pays for the one that arrived first. And the numbers get thinner from there. Only about 30% of American households ever receive an inheritance at all. Half of all inheritances come in under $50,000. The distribution is severely lopsided, with the top 1% of households receiving average inheritances near $719,000, while the bottom half of recipients average under $10,000. The great wealth transfer is real in aggregate and largely invisible in the median household. What is not invisible is a house. When the transfer does include real property, it arrives as the single largest item in the estate, attached to a reset tax base, an insurance policy priced for a structure built decades ago, and whatever maintenance the previous owner had no reason to do. So what does a 60-year-old do with that? Not keep it. The arithmetic does not support keeping it, and the arithmetic is not ambiguous. They sell. Which sounds like a clean resolution, and would be if this were happening to one family. It is not happening to one family. It is happening to millions of them on a schedule set by mortality tables, in the specific places where these houses are concentrated. 7 of the 10 American metro areas with the highest share of housing occupied by people over 65 are in Florida. Not 2, not 4. 7, according to the census analysis, with the concentration running heaviest through the coastal and warm weather regions the entire country understood retirement to mean. Wildwood and the Villages sit at the top of that list. And the overlap is not a coincidence, it is the structure of the problem stated geographically. The places with the oldest housing tenure are the places where the gap between assessed value and market value has had the longest runway and the strongest appreciation to work with. Florida caps homestead assessments at 3% or the Consumer Price Index, whichever is lower, and Florida home prices did not spend the last 2 decades rising at 3%. 2 decades of that divergence produces exactly the kind of gap that makes an inherited property unaffordable the instant the cap comes off. Then add the second line, which behaves nothing like the first. Property tax is set by local government and constrained, however imperfectly, by local politics. Insurance is not. It is priced against weather patterns and global reinsurance markets, neither of which respond to a county commission vote. and it prices a 1970s structure according to its roof, its wiring, and its exposure, regardless of how long anyone has lived there. So the heir in Florida is not facing one reset. They are facing a tax line that jumps at transfer and an insurance line that was already climbing independently on a house whose age is precisely what the insurer is pricing, which invites a fair question. This is not a secret. Assessors publish it. Tax firms write about it. Legislators in these states are aware of it. Has nobody tried to fix it? They have, repeatedly. And the pattern of those attempts is the most revealing thing in this entire story. Florida's first attempt was portability, effective in 2008, letting a homeowner carry up to $500,000 of accumulated benefit to a new homestead anywhere in the state. It worked for the person still alive to use it. It does nothing at death for an heir who lives elsewhere and has their own homestead. California's attempt came through Proposition 19 in 2021, which expanded transfers for homeowners over 55 to 3 times in a lifetime, and simultaneously gutted the parent-child exclusion. It made the living owner more mobile and the inheriting child considerably worse off. The third attempt is happening right now in the live Florida debate over whether to slash or eliminate property taxes on homesteaded property altogether. Set aside whether that is good policy. Notice what it does not touch. It does not touch insurance, the line that government has the least ability to control. And it applies to homesteaded property, meaning an inherited house that the heir rents out rather than lives and falls under the separate non-homestead rules, where the cap is 10% and disappears entirely on a change of ownership anyway. 3 attempts, 3 decades, and every one of them aimed at the same target, the mobility of a living owner. Not one of them addresses the transfer event itself. The event where the cap dies is treated, in every version, as a settled matter rather than a problem. Now put the geography and the demography together, because this is where the consequence stops being personal. The census analysis notes that markets attracting younger generations may absorb these homes quickly and easily as they come free. Markets with aging populations and slow migration may instead face an inventory glut. Read that carefully. The places holding the most housing in the oldest hands are, almost by definition, the places with the fewest young buyers arriving to take it. The supply and the demand are not in the same counties. They are not even in the same states. So the question is no longer what one heir does with one house. It is what happens to an entire metropolitan area when the condition that held its tax base in place for 40 years expires across thousands of properties inside the same few years. It reprices. All of it, and not because anyone decided to. Recall the detail from the beginning, the one buried in the mechanics that almost nobody reads. The reassessment is not triggered by a sale. It is triggered by a change of ownership, and death is a change of ownership. The county assessor does not need a listing, a buyer, or a closing. It needs a recorded transfer, and a death certificate is a recorded transfer, which means the schedule of this repricing was never set by the housing market. It was never set by a legislature, or a rate decision, or a cycle of any kind that anyone forecasts or votes on. It is set by a mortality table. That is the thing to sit with, because it changes what kind of event this is. Market corrections are driven by decisions. People choose to buy, choose to sell, choose to lend, or stop lending, and those choices respond to prices, to rates, to sentiment. Every one of them can reverse. This does not respond to anything. Compare it to the last time American housing repriced at scale. That event ran on credit, and credit is negotiable. Terms get modified, payments get deferred, programs get written, and a government that wants to slow the process has instruments to do it with. There is no forbearance program for mortality. There is no rate cut that postpones it, no modification that restructures it, and no agency with authority over it. Roughly 12,000 Americans turn 65 every single day, and the boomer cohort now spans ages 62 to 80. The transfers are not a possibility to be modeled against a range of outcomes. They are a certainty being distributed across a known window, and no policy, rate, or market condition alters the schedule by a day. And when each one lands, the removal is not partial. Florida's own county appraisers state it flatly. If the property changes hands, the cap is removed, and the new owner establishes a new base year. 40 years of suppressed assessment does not unwind gradually. It is deleted once, and the property is written back onto the tax roll at full market value. Now here is the part almost nobody says out loud. Who gains from that? Because someone does. Every one of those resets raises the county's assessed value base, and it raises it by the entire accumulated gap at once. A county that spent 4 decades collecting tax on a suppressed number gets the full figure restored on thousands of parcels inside a compressed period. From the local government's ledger, this is not a crisis at all. It is deferred revenue finally arriving on a schedule as reliable as any revenue stream in public finance. The cap was never forgiveness. It was a payment plan with the balance due at the end, and the county always knew when the end was. Meanwhile, the same event doing that to the tax roll is doing something else entirely to the market underneath it. Thousands of properties come available in metros where, as the census analysis notes, aging populations and slow migration mean there is no arriving cohort of local buyers to absorb them. Supply arrives on a mortality schedule. Demand does not. And the assessment that now attaches to each property was struck at the moment of transfer against a value the market may not sustain once the inventory lands. So the resolution to what the heir does is the one the arithmetic forced all along. They sell. Federal Reserve data is direct about this. Inherited property is frequently sold rather than kept, and the inheritance converts to cash rather than remaining a long-term asset. The house leaves the family in the same year it entered it. It goes to whoever can carry a full market assessment, a modern insurance premium, and 40 years of deferred maintenance from day one, which is a specific and narrow kind of buyer, and not a young family financing on a mortgage. A system built to keep houses in the hands of people who had earned them ends by moving them, at scale, on a fixed timetable, to whoever has the balance sheet to absorb the reset. Nobody chose that. Nobody voted for it. It is simply the arithmetic of 1978 arriving on an actuarial schedule. But notice what has and has not been answered. The house moves, the family exits, the cash gets divided. None of that makes the bill go away. It is still there, every year, forever, attached to the property. Someone is paying it. The heir pays it briefly in the months between the death certificate and the closing. Then the new owner pays it, permanently, at full market assessment. That is the obvious answer, and it is only the surface of one. Go back to the equation from earlier, because everything resolves inside it. A property tax bill is assessed value multiplied by the millage rate. That looks like a formula about a house. It is actually a formula about a budget. A county does not set out to collect a percentage. It sets out to fund schools, roads, fire service, and pensions, and the total it needs is decided before anyone looks at a single parcel. The millage rate is what falls out of the division, the budget divided by the total assessed value on the roll, which means the rate is not independent. It is a function of what everyone else is assessed at. Now apply that to a county where a third of the housing has been sitting under a cap for 30 or 40 years, assessed at a fraction of market. The budget does not shrink to match. The road still gets paved. The teachers still get paid. So the millage rate rises until the same total is collected from a tax roll that is artificially smaller than the real value of the property inside it. Everyone pays that rate. But the people whose assessments are suppressed pay it against a small number, and the people who bought recently pay it against the full one. 2 identical houses on the same street, same square footage, same roof, same school district. One assessed in 1985 and protected ever since. One assessed at the closing price in 2022. The second household pays several times what the first pays every year for identical services. That difference has a name people rarely use for it. It is not a discount granted to the long-term owner. It is a transfer, collected annually from whoever arrived most recently. And this is where the question in the title turns out to have been answered the entire time. Who is going to pay the property taxes on 30 million homes? Nobody has been waiting to find out. The property taxes have been getting paid, in full, every year, for decades. They have simply been getting paid by the newest person in the neighborhood, whose bill has been absorbing the gap on the house next door since the day they signed. The bill was never deferred. It was redistributed. So when the cap finally comes off a parcel, the honest description is not that a cost appears. The cost was always there and always current. What ends is one household's exemption from it, and the redistribution reassigns rather than disappears. That is the shape of the whole thing, and it is worth stating plainly because every mechanism this video has traced is a version of the same design. 1978, 1992, the portability patch in 2008, Proposition 19 in 2021. Every one of them protects the person already inside the house and allocates the cost to the person arriving. That is not a flaw that crept in. It is the specification, and it is why the transfer of 30 million homes will feel less like a windfall than the headline number suggests. A house is not an asset that sits still. It is a subscription, billed annually, and the subscription price resets when the name on it changes. If any of this touches your own situation, there is exactly one number worth looking up, and it is public. Every county assessor publishes the assessed value and the market value of every parcel. The distance between those two figures on a specific property tells you what it currently costs to hold and, more importantly, what it will cost the moment it changes hands. Nobody sends you that number. It is not on the deed, and it is not in the will. It sits on a county website, waiting. Because you do not only inherit the bill at a funeral, you inherit it at a closing, and most people sign without ever having looked. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. If this changed how you read your own tax bill, send it to 5 people who own a home or expect to. And leave me an honest comment. Not whether you liked it, but what you want examined next. The suggestions in the comments are where these come from,